On today's show, how buying blocks of income can build a secure retirement for your clients. Part 2 of this week's series on Annuity Retirement Income with nationally recognized retirement expert Curtis Cloke. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to backroom technician and Inspire. Let's get down to business. Well, welcome to the show, day 2.
Thank you, Steve. Good to be here.
Curtis, before we get too much into this, we talked yesterday a little bit about SPIAs, DIAs, FIAs. I mean, we're talking about withdrawal benefits. We're talking about all these possibilities that are out there, installment, refund, cash. We still have people doing medically underwritten annuities. And so remember, we just want to touch on this, but if a person has a mortality issue and his timeline is going to be shorter, we have a couple carriers that are actually going to bump the benefit up based on that. Yes,
there are medically underwritten annuities. We've been using them, for a very long period of time. Oftentimes in the past, we've been able to use a medically underwritten SPIA to buy the income and then kind of work it both ways on the underwriting class of life insurance and arbitrage the squeeze at both ends. Mm-hmm. That's a really...
Generally not with the same carrier.
Generally not with the same carrier. And oftentimes we're not going to use the same carrier to do those sorts of arbitrages. But you can also use a medically underwritten SPIA with with two spouses on a joint lifetime. We did one about a year ago where we got a 10-year advance on one of the spouses. And it makes a huge difference in how much you can actually squeeze out of the income drop. Now, there are less companies today currently offering it. Now, there'll be more as interest rates rise, but right now the sphere of companies is quite small.
In Curtis's practice, as we talked about yesterday, this is top of the table, quarter of the table, MDRT, Forum 400 recipient. You have a huge personal practice. You're knocking out serious premium. I mean, when Curtis is not on the road, a couple of years, he's knocking out $20 million. And also $1 million in target premium. This is serious money with over $900,000 under management. When I'm looking at some of the things that you do here, I want to talk a little bit about, you talk about filling in the gap, this jagged edge thing. I've heard you talk about this. So explain this a little bit.
Well, people don't live perfect, smooth lines of income. The husband's a different age and he has a different level of income, a job. He may retire at one time, his spouse may retire at a different time. We're going to optimize Social Security. We're going to discuss optimization of the pension. And so incomes are going to start at different times. Some income streams are going to be coal-adjusted, others are not. And so obviously when building a retirement plan, getting all that math built into the calculations is very critical. And when you get all done, it's not this smooth line income like everybody perceives. I can't just normally go out and buy, 1-3% coal adjusted stream of income and call it good. I've got qualified money. I've got non-qualified money. I've got Roth IRA assets. I might have some assets inside a pension plan. I've got a multitude of different classes. Question is, how do I take that jagged edge of income need? How do I take the various classes and the available liquidable resources to reallocate? And how do I build in an income floor for essential inflation and essential income or lifestyle income, whatever the case, and fix that jagged edge? So
there's really no real smooth analog line here any longer.
It's very rare. Not saying it never happens, but it's pretty rare.
Now, when you bring up inflation, almost all year, I've seen a lot of your material. It seems like you are coally crazy. It seems like you're always putting it on here.
Well, more than 95% of the time, every case that we build with the 3 to 4% level of inflation right into the plan. What's different about our story is that we buy income and we invest the difference. And when we buy income, we do 3 things very differently.
Now, you're buying blocks of income. You're walling it off. This is the foundational number. Sometimes I've seen some of your plans go up to 50, sometimes 60% of buying income for the floor.
Yes. There's a suitable amount of total assets or net worth of a client one has to be careful about in terms of walling off her income stream. But obviously, income flow is the most important in my opinion. In other words, if I had a pile of money for which I had all this risk exposure sitting on the kitchen table, or I had a stainless steel machine about the width of a dollar bill spitting out my monthly income, if I were to lose one of those two, the machine or the pile, the one I probably wouldn't want to lose first is that machine. I wouldn't like to lose any of them, but if I had to lose the pile and keep my cash flow, retirement income, as long as I have plenty of cash flow, I'm mitigating inflation, probably pretty good. So it's protecting that income flow, but also having suitable amount of money for liquidity and things that we can't think of or can't plan on, and then being able to have opportunity for growth, and obviously everybody wants to leave some legacy.
When I'm looking at some basic ideas here, and I'm supporting this block, that's usually I'm going to have medical issues with them later. I might have some LTC issues. I'm going to have my expenses, and I'm going to have inflation on those expenses. So I'm trying to quarter off, or wall off, as you say, trying to put that in a whole sector of foundational thinking, and that's guaranteed for life with the appropriate COLA. And you said some of these contracts pay how high?
Oh, you're talking about the COLA adjustment up to 6.5% with some products.
I mean, that's huge. I mean, but again, I want to reinforce that may not be the winner. We have to run this on whether we're doing the annuity bulldozer that you put together or Canex. When you look at all this is what I really like about this. We don't care. This is why Curtis used this word agnostic, because we really don't. We don't care which product wins. We don't care how it works. We just want to know who delivers the best income. And you're surprised often, aren't you?
I'm surprised often what wins the day. There's, like I said, anomalies every day of the week. We had a particular client was looking for 27 years of income after he retired. And when we went out and shopped the best 27-year period certain, what we found was unusually a joint life 27-year period certain was $22,000 less present value to buy it than a straight 27-year period certain. Go figure. That's not anything that you would come to expect, but these are the kind of anomalies our lending team finds every day when doing all these various cases.
This is where retirement planning is going. We have to run the numbers on all products, on all scenarios. It doesn't take that long. This technology is unbelievable. Once you input the information, we come back. We're going to talk about what Curtis calls his 3 principles. We'll be back in about 30 seconds. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, we're back with Curtis Cloke. Curtis, we're talking about your 3 principles. Let's talk about this first one, maximizing tax efficiencies and the exclusion ratio with what you call, not FIFO, not LIFO, but FIBO.
Well, you know, every one of our consumers recognizes last in, first out. If I say last in, first out LIFO, you know, pretty much most clientele understand that. When I'm talking to an accountant, when I'm talking to an attorney, most people get that. Obviously, advisor world and agent world, they're going to get that. And then I can say FIFO. If you understand LIFO and I say first in, first out, you kind of get that. But there's something with income annuities distinctly that the IRS changes the order of how taxes are played. And this tax efficiency is underestimated. And the technical term, of course, is tax excludable income or tax efficient ratios. You say that to a client and watch the eyes roll back in their head, right? So what I discovered many years ago was a term in a chronological discussion of terms that are regularly used to get clients to understand the difference between LIFO, FIFO, and now FIBO. And FIBO stands for first in, blend out. So I put principal dollars in. If I do a DIA, I've got a period of accumulation, and then over time, I've still got additional growth as I'm distributing that income out. Depends on if it's period certain and it's real, whether it's life contingent and it's implied. But when I turn that on, I'm going to get this experience of first dollars in, and then they're going to let me prorationally blend out. And what I'm able to do with that is substantially stretch out over a longer period of time the gains and control the tax brackets by being able to do it that way. It's a very powerful change of order of tax.
When you're talking about this, and I think you have a second slide here.
And the second one that I want to talk about is there are new indexed DIA chassis out there that are very interesting. So when I ladder exclusion, taking advantage of standard deduction and exemptions, I can then ladder on top of that a very high level of income, whatever the case may be, for a while with FIFO. So the gains, basically I put basis in first, the gains grow on the back end, and when I turn income on, I'm taking my basis first. And these new indexed DIA chassis, as I like to call them, what they do is that you put the dollar amount in, and it's an indexed type of chassis where if you buy a particular an index, external benchmark of the S&P, whatever, the crediting of that doesn't impact the cash value. The crediting of that rolls up the roll-up rate for the lifetime income withdrawal when you turn it on sometime into the future. And because no credit ever is granted to the principal to real cash value. When you turn on the rider withdrawal, you're pulling $1 from the basis. So laddering excludable income on top of FIFO with this DIA concept, I can actually create an amazing Social Security bridge that creates a very low, if no tax bracket, depending on the stream of income of the client, and at the same time delay my Social Security for optimization and then also bracket bump Roth conversion opportunities before 70 and a half.
So you're really leveraging the exclusion ratio to its nth degree.
Absolutely.
Talk about your tax efficiencies. You know, there's this, I have non-qualified monies, I have qualified monies. There's ways to play this.
Yes, so there's something that we have kind of created that we've termed RMD compression. One of the ways to use RMD compression is when you annuitize all the IRA assets, if you've got a plan that fits well for, and you're building in a COLA, and understand the ability to do a COLA under the COLA provisions on qualified is going to have a different set of rules than non-qualified, because you're going to have some limitations on qualified money, and every carrier has their own particular subset on what they're going to allow on a COLA. But when you do a COLA, you can actually, on a COLA income annuity, SPIA or DIA, you can actually shrink for a number of years in the front end a distribution that more closely matches the income gap at the front end that may be less than the required minimum distribution if I held it outside the income annuity. That's one element of RMD compression.
Another thing you do in your principles is you like to, and I do too, I want to minimize and even eliminate, if I can, fee drag.
Yeah, this is one that many folks really don't understand, and that is that when I buy a CD at the bank, I don't pay a fee. But if I go, whatever bank I buy that CD from, if 2 minutes later I go back to the loan desk and say, now I want to borrow the money. By the way, I think it's about 1% for a 5-year certificate deposit day. But if I go loan that same money from the same bank, it's 5 or 6%, right? Well, there's no fee,
right?
But there is a spread.
Yeah, I'm thinking, and that's the same thing with our products.
And it's the same thing with an income annuity. When they build the income annuity quote, they're expecting a spread. Now, the onus of delivering the spread is the onus of the insurance manufacturer, the insurance company, and how they build and build their own portfolios. But once that spread's been built in, and I get a quote, and I calculate the math and science from the dollars I put in, the dollars I get out, there is no ongoing fee drag associated with that stream of income.
And just as a summary statement to the fee drag issue, remember, we're talking about whatever the registered investment advisor is charging. We're talking about the fund expense. We're talking about the statement of additional information. There's a lot of expense loads here, and many times when we see doll bar studies and so forth, that's showing the gross rate. It's not showing it net of all these fee drags. We don't have that issue on almost every way when we annuitize and do blocks of income. To me, that's powerful.
The advanced life deferred income annuities for age 85 and beyond, there are special rules that you can delay RMDs up to age 85 on 25% up to $100,000 of your qualified dollars. That would be another example of RMD compression.
Well, that's all we have for today. Remember, before moving forward with any of our ideas on the show, always consult your tax advisor, legal counsel, or your broker-dealer compliance officer. Missed an episode? You can go out and watch any of our past episodes at downtobusiness.ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. I'm Steve Savant. We'll see you tomorrow.